Hi, welcome to Let's Talk Forex with Alison and Chris. So in this episode, we're going to be diving into a topic that doesn't always sound so exciting, but is critical to your success, and that is optimizing your risk management. As always, if you have any questions, please reach out to us at podcast@epicscouts.com. Hey Chris, how's it going?
Hey Alison. Yeah, I'm okay. I'm okay today. How are you?
Yeah, doing very well, thank you. Looking forward to getting into this topic. I know it's something we speak about a lot, but I think it's something that's absolutely critical to your success as a trader.
We touch on it a lot, don't we, in other subjects. We always seem to circle back to it. So yeah, it's good to actually talk about it in a more serious way, more extended way, I think, for the listeners.
Yes, exactly. We're going to be providing a lot of different strategies and, and just ideas for how to manage your risk a little bit better or sort of refine the ways that you can manage your risk.
Yeah, exactly. Just different ways of thinking about it and taking it a bit more seriously, because risk management is not the sexiest topic in the world. I think a lot of people switch off when they hear it. Most traders they prefer to learn about, what's the next big trend in the markets or how to catch the perfect breakout. But the thing about risk management is, at the end of the day, like all Forex traders, we're just, we're glorified risk managers. And that's what we're doing. We're protecting our capital. And because if you don't have that capital, you can't trade. And if you don't manage your risk, then you're going to end up losing your capital.
Yeah. And I mean, besides obviously losing your capital, if you're not managing your risk well enough, it can also erode your mental capital. It can just really plunge your confidence. And that's not such an easy thing to get back. It's once your confidence is gone and you feel like you don't know what you're doing, it's very difficult to work your way up again. And, risk management just ensures that you don't get to that point.
I mean, the important takeaway here at the top is that risk management is not just a checkbox in your trading strategy. It's not just something you can tick and say, okay, that's job done. It's about setting yourself up for long-term success, whether that's, protecting your capital or, as you say, protecting your mental capital. If you're serious about trading, you need to focus on risk management, and it should be first and foremost in anything you do.
Yeah. And before we dive into the specifics on, of how you manage your risk, I just want to touch on a topic it's kind of tacit, but it's something that you do also have to think about in terms of risk management, and that's discipline. That you can have the best risk management strategy in the world, but if you're not disciplined to stick to it, then you might as well not have it at all. And, it's all about execution. You need to work on your discipline first before you start creating strategies that you're not going to stick to anyway.
Yes, exactly. I couldn't agree more, Alison. Discipline is the foundation of every part of your trading strategy, and it's certainly the foundation of risk management here. But now let's talk about risk management in a more specific way here. There's some non-negotiable risk rules that I think we're going to go through here. For me, it comes down to, there's three pillars here. There's a daily risk limit, there's your weekly risk limit, and then there's a maximum drawdown. And you need to define those when you're going to talk about them. And these, once they're defined, these are going to be the safety nets that keep you in the game, that protect your capital and allow you to keep trading.
Yeah. It's very important to have those boundaries in place. Without them, you're basically opening the door to disaster. And as as many traders have experienced, you can bend these rules a few times. You're not going to get away with it for very long. And one of the most sort of fundamental risk management rules, and I guess a good place to start, is not to risk more than 1% of your capital per trade. I know we've spoken about this many times before, and the maths on this is very easy. It's easy to calculate how much you should risk per trade, and therefore, your position size, and where to set your stop loss, etc. But again, what's more difficult is sticking to that rule. The discipline required to only risk 1% per trade is not as easy as it sounds.
Yeah, absolutely, Alison. It's really interesting how often traders ignore this basic rule. It is a really basic rule, and it's most traders, I think, will have heard about it. But traders get caught up in the excitement. There's always this kind of gambler's mentality that there's one big trade, and it's going to make you a month. it's going to make everything all right. But the reality is, if you're consistently risking only 1% of your capital per trade, you can endure a really long losing streak. And that may happen to you. Certainly happened to me. I'm sure it's happened to most traders out there. And if you stick to that 1%, you're still going to have the capital to recover. I think a really good idea with this 1% is pair it with a 2-to-1 risk reward ratio. So I know it's something you talk about a lot, Alison. And this ensures that your winners are going to outpace your losers. And even if your win rate is only about 50%, if you've got that 1% risk reward, 1% risk per trade, and you've got that 2-to-1 risk reward ratio, you're probably going to come out okay.
Yeah, exactly. And the next technique I want to discuss is your stop loss placement. And you should place this based on volatility rather than on arbitrary levels. So many traders go about setting their stops below recent support levels or above recent resistance levels. And this is a rule. I know if you look at YouTube's videos across the board, this is sort of what people talk about. But you've really got to read the context of the market. So instead, I often recommend that traders use the average true range or the ATR. And a good starting point is to set your stop loss at a level 2 to 3 times the ATR. So this then allows you to account for the market volatility, and it gives your trade room to move.
Yeah, no, you're absolutely right, Alison. Having an ATR-based stop is a great idea. It's a more adaptive approach, especially in changing market conditions, as you pointed out there with news events hitting. Because what often happens with these news events, you get spikes in volatility, and if your stop is too close, then you're going to be caught out. With that wider stop set by the ATR, you're gonna stay in the game. But conversely, during quiet periods, a tighter stop is also a good idea, because it's gonna help you manage your risk without giving up too much of your position. Speaking of which, it's crucial to size your trades accordingly. So if you are going to have that wider stop, if you are going to use an ATR, then make sure you're not overexposed.
Yeah, exactly. I often use dynamic position sizing. So it basically means that you adjust the size of your trade based on your confidence levels or on the different market conditions. So if you're trading, for example, a very highly volatile instrument, you might size down to reduce your risk. While if you're trading something that's, or you found a high probability setup, then you might size up, or you might scale into the trade as the trade's going in your direction, and you've managed, you've found that you could move your stop loss a little bit closer to your entry point. You might then scale into the trade, or you might scale out of the trade if you find that, that it's not going your way. So there are many ways to use position sizing to your advantage.
Yeah, absolutely. Dynamic position sizing is a great tool, but it does require, as we've touched on already, requires discipline and a deep understanding of your strategy. Some traders, might see it as an excuse to go all in on a gut feeling, and therefore you're going to whack up your position size. Instead, you need to assess your trading position more objectively than that. And one way to do this is by tracking something called your expected value, your EV. By calculating the EV of your trades, you can determine whether increasing the size on certain trades is statistically justified or not. And you need to do this based on historical performance, obviously.
Yeah, and that's such a key point, Chris. Another advanced technique is using time-based exits. Many traders focus solely on price-based stops or level stops, but adding a time element can really improve your results. I know it's not often talked about, but what I find is that if you've got these time-based stops and the trade doesn't move in your favor within a certain number of bars, I know a lot of traders use 7 bars as sort of the golden number of bars, obviously depending on your time frame. Then as soon as it hits that bar, that 7th bar, and the trade isn't moving in your direction, they exit the trade. And this prevents you from holding on to trades for too long, obviously, and tying up your capital, and obviously increasing the chances of slippage. So it's quite a nice technique. I sometimes use this, and I find it also just helps preserve my mental capital, as we were talking about earlier, and my confidence that if it doesn't move in my favor and is, within a certain time, it's best just to get out and, wait for a better setup or wait the next day.
Exactly. Yeah, removes the emotional aspect from the trading entirely. No, very useful. I couldn't agree more. It's a really simple but effective way to cut the dead weight from your portfolio as well. And let's not forget about scaling in and out of positions. It's something a lot of people overlook. Rather than entering your full position all at once, consider scaling in. Start with a small position to test your thesis, to test your trading idea. And if the trade goes in your favor, then you can add to it. You can build on it incrementally. And this will reduce your initial risk and allows you to build a larger position with less exposure. It's a win-win all around.
Yeah, exactly. As we were just saying earlier, that you can also scale out of your profits without exiting the entire trade. So you can basically take half your position when the price hits your first target, and then you can let the rest of your trade sort of ride with the trading stop. I know trading stops are something used quite often. It obviously depends on the market and the market conditions. But scaling out and then using a trading stop, I find is very effective. This way you basically banking your profits, but you still give the trade a chance to reach sort of its full potential, if you like.
Absolutely, 100%. Yeah, trading stops are beautiful things just because once it hits your break even, it's out of your risk management. You don't need to keep it inside your risk management portfolio anymore. There's zero risk attached to it. So really, they can be, as you say, in the right market conditions, a very good risk management strategy. But let's also talk about maximum drawdown limits here. I think it's something that's not very well understood. Every trader should have a predefined drawdown threshold, whether that's 10%, 50%, or whatever fits your risk tolerance. If your account hits that level, you need to stop trading and reassess immediately. This is your emergency brake here. And it said prevent catastrophic losses that are going to wipe out your capital. Yeah, it needs to be predefined. It needs to be set in stone, and it needs to be acted on immediately.
Absolutely. And it's not just about stopping trading. Of course, it's about stopping trading initially, but it's about taking a step back. It's about reviewing your trades and really sort of looking at what went wrong. Were you over leveraging? Were you, using too large position sizes? Were you ignoring your own rules? This is where having a solid trading journal comes into play. You want to be documenting all your trades, your entries, your exits, your rationale behind the trades, your emotions during the trade. This way you can really learn from your mistakes and, improve your risk management.
Yeah. Great advice there, Alison. Let's wrap this up with a strategy I find particularly useful. It's called the break-even stop. And once traders moved a certain distance in your favor, move your stop to break even. It's a no risk position at that point. It's similar to what I was just talking about with the trading stop, and it helps protect your capital while it still allows that trade to develop, to keep on growing in your favor, hopefully.
Yeah, I love that strategy. It's a simple way to, as you say, remove your risk without prematurely taking profits, I guess. You don't want to be moving your stops too quickly, but you also want to give yourself room to breathe. So you also got to be aware of moving to break even too early because, of course, you can then get stopped out by normal pullbacks or normal market noise.
Yeah, absolutely. Risk management isn't just about avoiding losses. It's about optimizing your strategy to grow your capital, protect first, and then think about growing your capital. And by using a combination of these techniques we've talked about, so there's proper stop loss placement, that's dynamic position sizing, scaling in and scaling out, time-based exits, tracking your drawdown, you're really giving yourself the best chance for long-term success.
Yeah, I think that's very well said, Chris. And, I hope our listeners take these bits of advice into account and that, that you start implementing them in your own trading if you're not doing so already. As we said earlier, it's not the most glamorous part of trading, talking about risk management. It's not a sexy topic. It doesn't tell you how to maximize your win rate. But if you don't use good risk management or solid risk management strategies, you are definitely going to land yourself in a very difficult position and possibly blow your account. So yeah, the takeaway from this should be just that, just take your risk management seriously.
Yeah, exactly. Take it seriously. As you say, if you manage your risk like professional, if you take it seriously, then the profits will follow after that. If you enjoyed this video, please give us a like and be sure to subscribe to us for more tips and strategies. We're always here every week And we're always going to be talking about ways you can improve your trading game, whether that's through risk management or through strategies or trend following, etc. Thanks so much. And I'll speak to you next week, Alison.
Yeah, cool. Take care, Chris.
Bye.